Canadian investors are using ZSP over any other ETF for exposure to the S&P 500 index. Institutional investors, investment advisors, and DIY investors have all been trusting ZSP with their investment dollars since the fall of 2012. ETFs provide instant access to a portfolio of stocks to an investor in a single, cost-efficient trade. For an investor to own the entire index would require institutional-level trading systems and expertise. To accomplish this, an investor would have to buy 500 stocks at a time, and then as the market moves, it would constantly have to rebalance those 500 stocks several times a year. ZSP simplifies this process by aiming to provide instant access to the 500 stocks in the index in a very easy and low-cost way. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a Loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to Loonie Hour, episode 158. As always, joined by the three amigos, Boomer, Keith Dicker, IceCap Asset Management, Rich Diaz. What's going on?
Well, we are in the sea. We had 1 degree Celsius. What's that, about 85 Fahrenheit, Rich? How warm is that?
I don't know. I'm a metric man.
No. It was pretty cool here this morning. But I have a so if you're from the Maritimes or Newfoundland, you guys, we have a kitchen party. Ever hear of that? Do you guys know what that concept?
Oh yeah, you're the only people in the whole world that have kitchen parties. Tell us more
The hell
about
is
this.
a kitchen party?
Well, I think in the UK, you guys have, is this stair parties? I know in
Everybody
London.
has kitchen parties, you turkeys.
They do?
Yes, of course.
Anyway, I was at
Anyways.
a kitchen. Well, it's just a party, but it takes place in the kitchen.
You just call it a dinner party, no?
No, it's in the kitchen though. Everybody hangs out in the kitchen.
It's not a dinner
That's where
party.
the action is.
Because you're closer to the drinks. I think that's why
must be a big
works out
kitchen
that way. Yeah, they are. Anyway, I was chatting with a gentleman named Graham. So Graham, hi to you. Nice chatting with you. He follows the podcast quite a bit, and his favorite person in the podcast is survey
Me.
says
Me.
yes. It's always Rich, of course. Everyone loves Rich.
Well,
Ooh.
does that
Ooh,
explain
lots of
my
conversations.
horrific? Does that explain my horrible background?
you have
Yeah,
like
where are
the white album
I'm-
there behind you.
That's right. I'm in London again because I can't seem to get rid of London. I'm in London taking care of some long overdue
British,
business.
Rich, British accent, please.
I'm in London, mate. Taking care of some business. Taking care of some long overdue business. And here for the week, it's been really, really sunny and beautiful. I brought the weather with my sunny disposition. And I'm in the old WeWork, except that now it's no longer a WeWork because WeWork went bankrupt, I think. And so
They still call it WeWork, don't they?
Oh, I don't know.
Didn't
Not-
Adam
not
Newman
this
try to
building.
buy it back?
Did he? Oh, I don't
That
know.
little weasel.
He is a weasel, and it's a great spot. It's called Shoreditch. If anyone knows East London, I'm in Shoreditch.
I'm
gonna
just
go,
confused that people in Europe actually want to work. I didn't think anyone worked over there, but nevertheless, there you go.
Did you
We'll
see
get to that.
Macron actually address that? Macron said that it's high time they stop regulating the caps of water bottles and start investing in technology in the future.
Must
So
have missed that.
Macron's listening to the Loonie Hour.
Speaking of sunny dispositions, what was a favorite grumpy realtor have
Yeah.
going on with himself?
What's wrong?
these days?
I
Steve.
got not much. It's cold, quiet on the housing front. Actually, I will say this is very anecdotal. It's only been a couple weeks, but we've noticed a slight uptick in the housing activity over here. So maybe all these rate cuts are finally filtering through. I mean, modestly coming off of decade lows of activity. So any sort of modest uptick in activity feels pretty good. But
Wait,
that's about it.
activity like sales and buys, or
Yeah,
activity as in,
just
like
showing
shovels in the ground?
showing activity, people requesting to view properties, putting in offers, stuff that was sitting for many, many months is now getting some bids. So, it seems like it's picking up a little bit, which is probably a good thing. But at least for me.
All hail Krista Freeland, the sage of Ottawa, and the
It's all her tweeting is really moving and I guess this is actually the first week we haven't had a major housing announcement boosting the housing market. So no stimulus this week, but maybe we'll get it next week with the Bank of Canada, which we'll get into. The BOC is on deck next Wednesday, the 23rd of October. Mark your calendar.
I
It's
hear
a
they're
big
going to cut
decision. It's a big decision,
1,000
right?
basis
Because
points.
there are Twinkies and Unreal coconut chocolate bars.
That's right.
What else have I had over the years? I think
Lemon
I had a
loaf.
Twinkie in a long time. Don't forget the lemon loaf. Lots of value there. But anyway,
Wait, we have
let's
a
get on
guest
with it
next
here.
week.
We've
We have a wait. We have a guest next week, right?
Yeah, we got a guest next week. So BOC's cutting. Well, I mean, there's my guess. They're cutting on the 23rd. And so we have Tian Yang of Variant Perception. He's been on the show previously. I think they have a tremendous global research firm. And so he had some important comments to me. He reached out, and so we'll get into that later on in the show. But he's going to come on Thursday next week after the BOC meets to provide some of his input as well. So we do have a guest there. Rich, I think you've got a guest lined up as well in the next couple of weeks.
I do. It's a professor from Waterloo called Mikael Skurid. And actually, funnily, I don't know if I'm saying his name properly. We'll ask him when he's on the show. But he's a professor of economics from Waterloo. And funnily enough, he was my old boss's professor many, many, many years ago. And he's all over sort of the labor market, yeah, wage growth, productivity, all the fun stuff that we like to talk about, except he does proper research on it. And has obviously written some academic papers. And yeah, I reached out to him because I've been following him on Twitter. And he said, yep, right away. Except he's a little bit early for us. So Steve's going to be grumpy that day too. But we should get Chiang Yan to give us to mail us in his bet for the BOC, so we can force him to eat a horrible,
That's a good
horrible
question. I will
hostess.
send him an email now.
We should get him, and then
So we'll come up with our bets as we move along here, and we get into the analysis of it first. But big day, realtors everywhere have been waiting for the next Bank of Canada meeting,
and the ferry operator,
the ferry operator.
Boo,
That's
boo,
right.
boo. It's everywhere now. Like even right now, if you're on Bay Street, all the commercial banks, I bet you they have it on their speaker as well, because they are. I think they've been bullies over the last week, the Bank of Canada. So why don't we talk Bank of Canada? And it seems like we're threatening to talk about it, but
I mean, I don't think you can get there without talking about Canada's CPI, which came out a couple of days ago, Rich. Headlines CPI. So market expectations, I believe, were 1.8. Blue a survey of Bloomberg economists. The median expectation, I believe, was 1.9% on headline CPI, and we came in well below that at 1.6. So pretty big miss. Headline inflation year over year, 1.6%. What were your thoughts there?
I mean, it's difficult, right? Because we're going to talk a little later about some of the positive economic data that's coming out of Canada. Yes, Keith, I said that, right? Positive economic data coming out of Canada. But I think it's sort of more of the same. We got services that are propped up by shelter. You've heard that before here on the podcast. We've got goods that are being dragged down again by energy. So year on year, the energy component of the CPI basket is negative 8.3%. But then you've got other things like clothing and footwear, which is negative 4.4. That speaks to sort of the weakness we see in retail sales and consumption. Household furnishings down year on year 1%. Transportation, which is related to energy, of course, is down 1.5%. And obviously the usual suspects are at the top of the list, which is shelter, services, which are dragged up by shelter. And then other things like healthcare and personal and alcoholic beverages, you'll be happy to know, are up 3% year on year. The other thing I thought was interesting was all items ex mortgage interest costs are now down to 1.0 year on year. So I wonder what the BOC is thinking. You know, that people are gonna say, oh, it's their fault that inflation went up in the first place, and now it's their fault that inflation's going down. But I think it speaks to sort of more of what we've seen, which is energy, base effects, and then services doing the still annoying Steve, because we know, as we spoke about last week, that rents are coming down. And I got some anecdotal evidence about that, by the way, from my dear sister, who's been looking for a new flat. I don't know if I should reveal that, but too late. And she's been telling me that she's seeing apartments that she saw 6 months ago are getting marked down. I don't know. There you go. That's my
That's in
piece on
Montreal, right?
inflation. Yeah, this is Montreal.
But just to correct you on one thing, I'll get in trouble, of course, with saying this. The Bank of Canada didn't create the inflation
No, of course
problem.
not.
Yeah, I mean, it was the COVID policies that the entire world adopted. So
Sorry.
I know
to correct
we
myself,
can be a bit mean with the central bankers. We're not mean. We can be a bit accurate about the central bankers a lot, but it wasn't their monetary policy that that set us up where we are.
I just meant the mortgage interest cost component of the CPI basket is now down to 16.7% year on year, and it was at 32. I think it peaked
It was
at
30%, peaked at 30.
Yeah, that's
so
it.
now
Excuse me.
down to 16%. So yeah, I mean, still huge. Obviously, rent inflation.
Loonie
still...
hour math, 45.87% decrease.
Home rent prices, Rich, were up 8.2% year over year. Again, as we've talked about nationally, we're seeing a modest decline now in real time, and particularly in the major metros of Vancouver and Toronto, you've got double-digit declines in rent. So, I think there's a pretty compelling case here to suggest that inflation, while it's done its damage, I don't think is a threat in the very near term. And so we'll see. Keith, I think it's important to pick apart how these central banks sort of act around inflation, and how disinflation is really, in their eyes anyways, is a tremendous threat, right? I mean, we kept rates at basically 0% for a decade because we had CPI at 1.8 as opposed to 2%.
I think they actually get
ridiculous.
quite giddy. I think central bankers love it. It's like, think about it, like you're the specialty player on the bench. You're the power play guy or defensive, the penalty killing, and 5-on-5, and you get lulled to sleep, and all of a sudden you get the tap on the shoulder. You're going in. I think they're excited to play.
Wasn't it?
This stuff.
It was Yellen that said it was
To play God.
Inflation was the problem of our lifetimes or something.
Yeah,
well, yeah, you know what? It's a very good comment, Steve, because at that time they couldn't create inflation.
Mm-hmm.
Which if you kind of think about it, for over a decade, they're trying to create inflation. I think they're doing other things, but they still couldn't do it. And now all of a sudden they believe now that it was created, now we can bring it back down. It just doesn't reconcile. But Rich, you were commenting then, I was half paying attention, but you were talking about the Canadian inflation. Was it the Canadian inflation data that you were going through?
Yeah. You were half paying attention. I'll remember that. Yeah,
my other half was somewhere else. But last Friday, we had the Canadian employment number came out as well.
Right.
Steve's random number generator, the machine. And the employment data in Canada last week, it was okay. Like, it was nothing, if anything, it was more positive than what was expected. So over a 1 week period, we had employment data in Canada, which was okay. But so that's hawkish, you don't need to stimulate if that's happening. And then the inflation data, numbers are coming down a bit softer than what was expected. So you push those two together, the magic 8 ball says
cut 1,000%.
Yeah, you got to cut a lot, right? Again, some things don't reconcile here. But just for everyone to understand here, we always get clues to what's happening in the economy, and it's in hindsight. It can't be forward looking because of the way it is done. But we continue the trend lower and grinding tighter and things like that. But nothing yet is jumping out. That especially in the U.S. because the U.S. data is, again, some of it's okay. But just to set the scale for the Bank of Canada, for the previous, what happened at the last meeting? What did they do?
25.
25, baby, cut. The meeting before that, what did they do?
Sorry, I screwed up.
25.
Start over.
Start over? Okay, let's just stay on Steve's track. Steve did a 25 and another 25. In the meeting before that, 3 meetings ago, what did they do?
25.
25, that's right. 25, 25, 25. And then we have 2 meetings left for the year. Just, things are grinding tighter, which Rich has shared with us. But for some reason, out of the blue, the big banks and on Bay Street, they are not suggesting, they're screaming now at the Bank of Canada to do what next week?
50. Jumbo.
50. And what for the December meeting?
50.
Man, Steve is on right on cue here this morning, hey? So you think about that, the economic data it's trending lower, right? But nothing has gone into crisis mode. Yet the Bank of Canada is clearly acting as if they are in crisis mode. The banks on Bay Street, they're acting as if they're in crisis mode. Yet on the Loonie hour, we're still doing Loonie hour math, and it doesn't add up.
Well,
Well,
Keith,
here,
what are the current market odds as we get into the BOC expectations here for next week? What is the market pricing?
The
Drum roll.
It is market pricing 48 basis points. So
Round up.
99% chance they're going to cut 50 because they have to now. They have no choice. They've been told they have to.
Well, I mean, the markets are setting them up, so
Yeah, because
They
if
have
they
a
don't do
choice.
50, yeah. Oh, Rich, my boy, there's no choice in the investment world. You do what you're told, or you lose your job, and someone else will take over that nice seat up there.
what do they have? What do they have for the next meeting after this one? Is the market pricing in 50 as well, or is that just Bay Street?
No, not quite. That the market is pricing in. It's maybe 35-ish, 40-ish.
Okay, so they're undecided between 25 and 50.
Yeah. There's a higher probability for, now everyone now knows the word jumbo rate cut, for a jumbo cut next week. And then in December to the end of the year, it's looking more definitely a 25. But I guess we need if something else happened.
So what are we thinking?
50.
Are we all 50
Well, think
here,
of it.
Rich?
25, 25,
No.
25, 50.
Rich just continues to pack on the carbo load in here. You want 25?
I'm putting 25 down. I think they're going to be consistent, and they're going to show that they're independent, and that they're
Man,
not.
this guy is naive, eh, Keith?
I think it's the British air or the
Also, maybe it is the British air. But the other thing is that the bond market, as Steve wrote in his excellent weekly newsletter. There's a plug for you, Steve. We never give
Thanks,
you a plug.
man.
There's one for you right there. Steve wrote, I think it was 2 weeks ago, that the bond market has already done a lot of the work. So the 2-year government bond yield is already at 3% or 2.99. The 5-year is at 2.88, which means that, I'm getting out of my lane here, but fixed mortgage rates have already sort of adjusted to this new reality.
Mm-hmm.
And so I don't think that they need to really to cut 50. I think a lot of the bond market's already sort of done that work for them. And so they could just carry on their pace as independent, fiercely independent central bankers.
actually means they do have to do it. Because then
Why?
Well,
2 years out,
see,
3%.
you go to, how long have you been to UK now? 3 days? You're in
2
fantasy
days.
land again. If the market is at one level and the theoretical value is at something else, unless you're a commie, the Bank of Canada rate has to come down to where the market is. Because if not, there's a whole bunch of money out there that's going to be priced off sides, and it'll change rapidly. It's going to cause a dislocation in the market. Someone's going to get in trouble. And then, well, guess what happens then? Then they have to cut 50. They have to go back there again.
Well,
I'm down for 50.
When I'm right,
Steve,
when
put
I'm
me down.
right, you have to eat.
All right, Keith's down for 50. Rich, 25?
Yeah.
All right, I'm going with the boomer. I'll take the old man wisdom here, 50 basis points. It's good for my business too.
What was that, Sonny?
50 basis points, jumbo. Cut, baby, cut.
Old man yells at clouds. 50.
All right, well, we got a 50-50 and a 25. Yeah, Rich, I just brought up that point there in the article just because I think like that's the largest consensus I hear in my business. Dealing with retail clients day to day, buyers, sellers, everyone just talks about they're cutting rates, so like I must automatically get a cheaper mortgage, right? And it's like, well, no, like your 5-year fixed rate mortgage is largely priced in a lot of the easing already, right? So I think even if we get to sort of where the BOC is going over the next 6 to 12 months. I mean, your 5-year fixed mortgage might still look like it still might 4%, 3.8, 3.7, 3.5. Like it's not getting a whole lot cheaper. So it'll be interesting. I think there's a lot of Canadians that will still need to adjust, right? I mean, people that took out mortgages in 2020 near the lows, and you're going to be renewing next year in 2025. Your 1.8% mortgage in 2020 might look like 3.8. So there's still an adjustment, but I think it's relatively manageable. I think the worst case scenario so far, anyways, has been largely avoided, which is last year in the fall of last year, I think like we had rates in the sixes. So
I think,
I mean,
though,
go.
Rich, your point about 25, and for if we didn't have a market instrument to tell us what the market is expecting, and instead it's just pundits saying what they should do and everything, it would, for me, I would suggest, if I'm running the place, it would be okay at 25. That's what you would do. So I'm still not seeing the evidence or the data to scream that it has to be 50, because we've already done 75, 325s in a row. But again, all of a sudden, if we're getting behind the ball somehow, again, it tells me that something is deteriorating very, very quickly. And then I know, the mainstream media and the central bank narrative is that, well, inflation is coming down, so we got to come down to the target rate. That's why they're doing it. I think people are just being incredibly naive to believe that, because you're being, you believe everything you're told, and the answer is, you shouldn't. You should have free speech, right? Unless you're a commie and then you just take what you're told. I'm on this commie kick now. I'll get over it.
You are.
We're
We're gonna get in trouble. We're gonna get
ticker.
letters. We're gonna get letters. But listen, I want to further complicate this because I think it's important, and that there's a couple of things that are really important. Number one, our finance minister told us that the economy is doing fantastic and great. And I'd like to support that commentary by highlighting 4 pieces of data that are actually okay, which is there's the BOC's business survey, future sales. So they do a bunch of surveys. They ask you what's going on in your business and economy, and that's actually doing all right. So it's back above 0 after spending most of the last 3 years below 0. So that's on balance.
We should say it's recovering, not it.
Yeah, it's recovering.
Doing all right maybe is not the best word. It seems to be recovering.
Right. You're right. So then there's the RBC Market Manufacturing PMI, which after spending almost 2 years below 50, remember 50 is the line on the diffusion index above expansion contraction. We're now in expansionary territory. And let's keep in mind that our largest trading partner continues to carry along. Then there's the CFI Business Barometer, CFI IB Business Barometer, which is a small business barometer. And that is at its basically long-term average or just below its long-term average, signaling that, economic growth is okay. And then we've got the composite leading indicator from the OECD, which is made up of consumer confidence, business tendency, financial markets. Yes, Keith, there are some stock price indicators and interest rate spreads in there. Labor market indicators are doing okay, as we saw last month. And so, it's not as like cut and dry as I think that the market's making it seem, or the banks are making it seem. That's on the one hand. On the other hand, which I'm speaking about both sides of my mouth, you guys know how I feel about the problems in the housing sector. Sorry, not housing sector, the household sector, and that's what we've talked about over the last few weeks. So yeah, I just don't think it's as cut and dry as people are making it seem. Is all.
But what you are seeing is the leading indicators are starting to turn up. And this is part of what Tian with Variant Perception actually reached out. So this is, unprovoked, which he reached out and said, hey, I just want to let you know, I was on the Loonie Hour several months ago, and we talked about the perils of the Canadian economy. Our models are suggesting that things are starting to recover and point higher, that, in the future, growth looks better. And so he wanted to jump on the podcast and chat about that. And coincidentally, Rich, your models are showing something similar, which is maybe we are on the cusp. Again, it's never cut and dry, but maybe we're on the cusp of a recovery, at least parts of the Canadian economy. I mean, we can certainly discuss the merits of housing, but
Yeah, I mean, it's just important to keep in mind. Like, don't get me wrong, I have my view, and it reflects Keith's view, which I think we're slowly moving towards sort of an inevitability, which is we're going to have a GDP contraction that will reflect the per capita contraction that we've had for 2 years. But I wouldn't be me if I didn't talk about the data that is very clear and that's going the other direction. And I think that's all I think it's important to just to highlight.
Well,
Keith is gonna poop on my parade of balance.
no, not that. It's just that like this puzzle is a big piece missing from it. So if the data is okay and leading indicator models are pointing to an improvement in all that stuff, doesn't matter what the inputs are. Why the heck is Bay Street, the guys who have all the data for everything, are saying the Bank of Canada needs to cut by 100 basis points over the next 8 or 9 weeks? Again, like it doesn't add up here. Something is something just isn't correct. Something isn't right, and we'll find out as we move along, right? And again, maybe the banks are wrong, right? Maybe they're all of a sudden they're going to change their tune very quickly and say, "Oh no, our bad. We don't need 50." Or maybe the Minister of Finance is correct. Hey, everything is fine here, and the Bank of Canada is wrong for cutting rates and so forth. But again, to be on this very hyper aggressive rate cutting trend, and not just in Canada, the Europeans, Americans, and then everyone else, I just find it hard to believe that, hey, things are going well. Of course, if you're a real believer in monetary policy, everything, you'd say, oh yeah, they cut rates, so that stabilized the economy. No, it doesn't work that way.
No,
right? Because what was like, it's like three months ago, they cut by 25 and that's it. That's not enough to put a dent into anything. So again, like we are experiencing, it's really, what is the word? Is it theoretical, philosophical discussion, model change with our real economy, in our jobs, in our families, everything. It's happening in real time. Because again, like to go from 0 to 5 with rates, and then 5 heading, I think we're heading to 0. Like that's where we're going again.
I suppose you could say that the race to 0 is going to keep the economy afloat, and we're gonna achieve the magical soft landing. That seems to be the prevailing.
I agree with half of that. I think we'd clear. I mean, if you listen to ECB this morning, yeah, the race to 0 it's off, right? They've already, fired the pistol. Everyone is off to the races with it.
So walk us through that ECB.
Yeah. So first of all, though, I think we are literally going to this world, economic world, where, this is dramatic, but everyone's going to be at 0 or heading close to 0. And there's quantitative easing, QE is taking place by all the major central banks. And this time they will not be able to get off the floor. That's where they're going to be. I think that's where we're headed. And that's going to have big implications, for the financial markets. So, and again, until we get something to change that trend, that's where we're going. So if anyone disagrees with it, it's based on a view that, yeah, things will turn around or something. But for now, hey, we're headed, for that race to 0, which I think is a great title, isn't it? It's a great title.
There's two things that could happen before we get to the 0, though. Number one, inflation could reaccelerate. And 2, the bond market could squawk and say, we don't like this policy, which is actually what Drucker Miller said in an interview, which he said, this is not financial advice, but Drucker Miller said he shorted the bond market as soon as the Fed cut because he thought it was a policy mistake, in the sense that he thought there was still some inflationary impulse in the US. And he went the other way. And I mean, he's not always right, but he's very, very good. And you can, if we talked about a couple months ago, my model, again, we're throwing lots of models out there, but if the PPI, core PPI, which is X energy, is anything to say about it, and a much weaker currency, we could get some inflation reaccelerate in Canada in the core space. And that will change, I think, people's perception on whether or not we actually can get to 0.
I think that's where we're headed, though. I think we are headed to this economic world that the central bankers, again, this is what they're dreaming about, because they like, they do like to work. People, it's your human spirit. You want to do stuff. But I think we are ahead of this world where all of a sudden inflation's become very sticky. when the economy is still going to be grinding lower? And then they have that dilemma. Are we inflation busting machines, or are we taking the cue from the government to saying, man, you got to stimulate, because this is going down, that's going down. We need new jobs and everything. And, at the end of the day, they will always relate more to the growth side, even though they might say otherwise. So again, I do think we are headed to zero. QE, inflation at some point is just going to stop improving. And then we're into this like really odd and weird world. And then we'll get through that. And it'll be fun. It'll be fun to experience it, make money on it, and lose money for some people. But this is not a normal cycle, everyone. Not at all. So back to the ECB, Steve, where you want to go next?
Yeah, the race to zero continues. Heath, this has been your core theme. So maybe walk us through. I know you always have a good entertainment watching the ECB there.
Yeah, first of all, with Christine Lagarde, so walk me through her. I think she is exceptional for the job that she has. And she is the head of the ECB, but she's not the one setting monetary policy. Like she has a very strong team, and they're only as strong as their calculators, which I think in Europe they're missing a few decimal points and stuff on it.
Come on.
But I think she is incredibly skilled as a communicator and staying on cue with policy and everything. And I think before that, she was leading the IMF. Is that right, Rich? That's a bit of fiasco how she got that job. You guys can do your own research on it.
Anyways, I would just Google her.
Yeah. And before that, what was her position in France?
She was the head of she was the Finman for France.
She was
the finance minister of France, and she got her sticky fingers allegedly.
Again, you can look it up that one as well, everyone, right? But when you're in that kind of position and you are involved with these sticky finger situations, I think it toughens your skin. Hey, like you develop a good soul about it and everything. So I'm trying to give her a compliment for what she does. But what they announced today is, hey, yeah, things are slowing. We did cut. Everyone expected the ECB to cut, and they did. And but some of the quotes are really good that came out of them. So specifically, they said regarding the economy, the early year promise is petering out. So basically, they're saying, earlier this year in 2024, we're expecting the economy to be strong, and we're going to have, European-style growth, which is kind of muted itself. But yeah, sorry, our fault, our bad. That's not happening anymore. We are starting to roll over. And then they said, we cannot ignore the headwinds to growth. So again, they're making this shift away from, this inflation-busting policy machine to all of a sudden we have to, protect growth. And, the real irony in Europe right now, of course, and Rich, you pointed this out, I think, a few shows ago, that, Europe has been turned it's been turned upside down on its axis. Usually it's Germany, the northern part of Europe that's leading the way economically. And now it's the opposite. So you have the southern part of Europe, so Spain and Italy, and I think even Greece as well.
Yeah, and Greece, Greece is killing it.
They are, absolutely. And I was chatting with Michael Nicoleros the other day, and he's killing it on the beach over there. That's where he does his work all the time. But Europe is now that they've changed their tune to, hey, we now have to cut rates to protect us against declining growth. They don't talk about inflation anymore. It's growth. And it was great. So someone asked her a question about, are you going to achieve a soft landing? And, the answer wasn't, yes, we'll have a soft landing. It was, there's no recession coming. That was their response. Just blurted that out immediately. Hey, stop that talk right there. It's going to be okay. But the other point they brought up, and it's something that we talk about it as well with our strategies when we're looking at them. They recognize the real risk to Europe from an economic perspective is the potential for more global conflict, Steve, in the Middle East, between the Israelis and the Iranians, because they know if that happens, it's going to be very difficult for Europe to do well economically. So obviously energy prices are going to scream higher for them. Global trade for them with the rest of the world, especially the Chinese, is going to be kind of tough. So you hear them; they are, at least now, they're talking about the risk that we all know they're talking about, and they're not being sort of floofy about it. And but they are now loud and clear. They're part of this race to zero. And the only thing that's going to trip them up is if that there is more war or global conflict in the Middle East. If that doesn't happen, then I don't know if they'll win the race to zero, but they're going to come in pretty close. That's what I got from it today.
Ever been abroad and needed Wi-Fi? Download Saily. Tired of telecom oligopolies ripping you off? Download Saily. Want to avoid sketchy SIM sellers at the airport? Download Saily. Saily might be the only travel app you need. It provides an internet connection wherever you travel and saves you money on roaming fees. It's easy to use, affordable, and reliable all over the world. Saily is the modern, seamless way to get connected without the need for physical SIM cards. With eSIM technology, you can instantly activate service from anywhere in the world. No more waiting in line for a local SIM or dealing with expensive roaming charges. Saily offers flexible plans to fit your needs, whether you're traveling for work or leisure. Plus, you can switch between networks in just a few taps, ensuring you always get the best coverage at the best rates. Whether you're a frequent traveler, an expat, or just someone who wants more flexibility with their phone, Saily's got you covered. No hidden fees, no contracts, just affordable, reliable data wherever you go. Visit Saily.com/Loonie Hour for 15% off.
So what's the general, it's basically, you've got this race to zero, right? I think we can all agree that central banks would love to ease rates and ease policy and help out their leaders on the government side with deficits, interest payments, et cetera, because we know the system is loaded up with debt and you need these lower interest rates to sort of lubricate the system. But I guess to Rich's point, what is the likelihood that the commodity market and or the bond market doesn't play ball, which is commodities surge higher through geopolitical escalation and the bond market sort of revolts, and you get these bond vigilantes that don't agree with monetary policy and sort of force them to reverse course. I guess we're going to see how that plays out, Rich. But
yeah, I'll just jump in there. But I think that's where we're probably headed. So other models going back over the last 10, 15 years, again, there's no war taking place then. So you have to take it for what it is. But that is the scenario, Steve, where you can have declining economic growth and then inflation is just really sticky. Because if we do have, increased global conflict, the price of commodities are going to go up, not because of the demand side, but just the cost of shipping them. And then money will just, I call it sliding down the yield curve. So you could see the short end, just say, pick any, just say the Americans. Where's the Fed at right now? What's the Fed rate?
I should know that off by heart.
The Fed is at 19%. No, we're at 4.75 right now. At 5, we're at 5. So you could see, for example, the market pricing the overnight rate at 3%, and the price, because their money is just flowing into the short end of the curve. And then the longer end, like you mentioned, Rich Ruckenmiller, shorting the long end of the curve, going higher. All that can happen, but it's because we're going into a period that we haven't experienced before, which is war, right? Basically, and the Europeans are talking about it. So we'll see what where we go with that.
What's interesting is actually the container prices have actually come down, suggesting that there's either some calm before the storm, or the market doesn't believe it, or that there's been some kind of easing of those pressures. If you look at the Freightos index, I know that sounds like a weird name, but there's this great index called the Freightos index.
Fritos.
It's not Frito, although I love Fritos. I swear it's Fredo. I know it's a stupid name, but it's a very, very good index. And you can see prices basically, from Los Angeles to Shanghai and back. And then the one I was looking at is China, East Asia, basically, to the Mediterranean through the Suez Canal. And there's different types of ships. And actually, the container index, and I promised to share this chart with you, Steve. so we can share for the viewers. But yeah, it's actually come off well off its peak from the middle of the summer, suggesting, I don't know, maybe it's not as dire as it sounds.
Rich, Keith.
What do you mean?
Again though, with all this central banks, they continue. Everyone is rowing in the same direction. They're not disjointed. The commentary is the same. And we keep going back to, why do the Americans do 50, and, what we bantered around that, hey, somebody else is in trouble. And so like jumping over to the US now, Rich, I think this morning we had retail sales come out. And what other data have we had in the US now? Again, like nothing is really, it's like the Canadian data, right? It's not screaming, crisis moment at all.
Not at all.
Yeah, so again, things don't reconcile around the world. Someone out there is in trouble, or these central bank lads know a bit more about it than everyone else.
Keith, don't you think it's, so when you talk about like trouble, the trouble is really brewing in like that sovereign debt market, which is all these governments are loaded up, massive deficits, huge debt to GDP ratios. And, I mean, in the US, what interest payments right now are equivalent to what they're spending on the military. I mean, like, if you're the federal government and like, what are you going to do? You're not going to start, cutting entitlements. You're going to continue to spend the money. And so I think the Fed clearly realizes that they need to get US government interest payments lower, to sort of keep this whole sort of Ponzi system going. And that's not just the case for the US. I think you can make the case across the world. I mean, certainly, here in Canada, we're well aware of what's going on with Canada's federal deficits. We just had a report out from the PBO, the Parliamentary Budget Officer, which says the deficit is expected this year to exceed the Liberals' $40 billion pledge. So again, the government just sort of says, "Oh, we're going to spend this money," but it always ends up exceeding that. Here in BC, we just ran the largest budget deficit ever on record. And so, yeah, I just look at this, we unpacked as we've talked about the housing crisis here domestically in Canada, right? We talk about, let's say, Vancouver, Toronto, and we now say, oh, well, 30% of the cost of new housing is fees and taxes. And the only reason why it's 30% of fees and taxes is because these municipal and provincial governments are desperate for tax revenues, and they don't want to put the burden. They want to shift that tax burden onto annual property taxes, right? For the boomers, the seniors, whatever, people that are living there. So what they'll do is they'll jam it over to the developers, because nobody notices that. The only people that notice it is the developers. And so I coming full circle is just, you can kind of see it's all just this one large sort of Ponzi that we're trying to support a system, and the system has been built on governments promising a lot of things and not having the revenues for those promises.
I think you're right, Steve. Maybe that's because we talk about here, why are they cutting? Why the jumbo cuts? Why do 325s and then 250s for the Bank of Canada? And why are the Kiwis expected to do 75, Rich, at the next meeting? So maybe it is this coordinated, conversation on the fiscal side. When these, you cannot improve the deficit unless you cut spending or you maintain your spending level and growth accelerates and your financing costs stay at least the same. And there's a lot of variables that are just not going in the right direction for everyone. So maybe it is, you go back to this, hey, let's bring everything to zero, and then you do QE, then you go with a central bank digital currency, you buy up all the bonds out there and swap it out for the digital currency, and then hey, the problem is solved. It's done.
Well, I mean, yeah,
Okay, but
we talk about bond vigilantes.
And that's
right?
where we could go, right? I think that's where ideally the world would want to go for anyone in the policy making world who could understand what I just said. But I think that's what they see as the solution. And, along the way, you just have to hope that it works out. And you know what hope is.
I mean, isn't this just the whole case though? We've talked about on the show, which is just like Japan is like the forward-looking indicator to some extent, which is they've had rates on the floor for several decades, and they hint and they say, "Oh, we're gonna start raising rates off the floor." What did they raise rates, Keith? 10, 15 basis points, and their bond market blew up.
Yeah, but Japan's different. You can't compare anyone else
It
to
is different. It is
Japan.
different. It's ridiculous to compare Canada with Japan. This country has massive current account surplus, and use that surplus and recycled it and owns all kinds of products and services elsewhere. As has a rising per capita GDP. I just want to pour some cold water on the government interest payments as a percentage of debt. In the you can just Google it yourself. I mean, in the U.S. government interest payments as a percent of GDP in 1988 were 5%. It's now 3.8. So yeah, it's about the same as military spending, but it's been much higher in the past. And Canada, you know my feelings on our government. I don't hide those at all. Maybe I should. But consolidated government interest payments as a percentage of total revenue in the 1995 was 23%.
Was that not followed by a period of austerity though?
It was, which is what I think should happen. And probably won't. But
And
right
I'm
now,
just
it's
curious what the political
8%.
appetite is today, where everybody wants a free handout.
Yeah, that's yeah. I mean, I'm not.
Guess what I received? Guess what I received this week?
You get your Canada carbon rebate.
My Canada carbon vote for the Liberals check.
I get your entitlement
I received
too?
money in my bank account. I don't know how much it was. $180, I think. I don't know what it was, something like that.
What a joke.
It just arrives.
What a joke.
And I don't know why. I have no idea.
You get more than you give.
Anyway, I just want to say, the reality is revenues as a percentage of GDP in the U.S. tax revenues is relatively low. I mean, this idea that the U.S. is totally broke and they're bust. I mean, don't get me wrong. I don't support 8% or 6% deficits as a percentage. Sorry, 6% as a percent of GDP deficits when you're at full employment. It's ludicrous. Obviously, it's very inflationary. There's no doubt about that. But to suggest that it's over and they're going to wither away, when we know that it's been much higher, these numbers have been much higher in the past, and they have for Canada. I think that the problem is it's like, are you going to force are you going to force the richest, and I mean the boomers of our society, to pay more? Probably not. Are you going to force millennials that are the new largest voting bloc to pay more? Probably not. And so I think that the way that you square that circle is higher inflation, because that is a way of taxing people by stealth and paying for all this debt. And I know Keith and I disagree on this philosophically, but I think that's where we're going.
Boomer, put him in his place.
I think it's the water that are you drinking out of the Thames over there? Is that what's happening?
Tap water is fine. Tap water is fine.
You know what? It's always interesting to compare the current period to a previous period and stuff like that. But you also had to consider what was happening at the time, because again, it's not this real easy formula, that we're looking at. There are a lot of moving parts involved here. But I keep going back to where, the policymakers today and the money spenders with our governments, no one has that experience yet in having to deal with it, because we keep saying it. We're now like 15 years where price or risk was not allowed to be expressed because we were at zero. We hit the ground floor already, and with QE and all that stuff. And I know you can make an argument that Japan is different on some levels, but they're not. They just moved ahead. And all what Japan did that was wrong with hindsight, they would not realize the losses in their financial system. That's
we agree on something.
That sounds like Canada.
That's right.
I mean, there's losses everywhere.
It's what China's doing right now. They refuse to write off the debt on those bank loans.
Yeah. And so where are the losses right now in the financial marketplace? And, where should they occur? And it's people always think it's the stock market all the time. Oh, that's, it has to go to zero, or, or something like that. No, it doesn't. No, the stock market is not going to go to zero. It could very well have an initial reaction to one of these events that take place, but there's a lot of residual value all the time in the stock market. But it's the bond market where we need to have, losses to be realized and recognized and accounted for. But because it is the bond market and there's a whole lot of financial institutions out there that are required to have bonds as their regulatory capital, that's what creates some bad moments out there. And I think that's what they're literally trying to work their way around. And, so back in the 90s when Canada was having their challenges, or, back in the sort of mid 80s, in that time, it wasn't, the US had too much money coming into, so they had to deflect it elsewhere. So that's when they did the Plaza Accord, try to weaken the dollar relative to the pound, which deflected everything to the yen, and there's a lot of different things going on. Where we are, like, so for example, what's really interesting over the last month or month to date? So what's happening with gold these days?
Yeah, I was just going to bring that up. You beat me to it.
Yeah, gold going straight up there. So
2,600 now. It's almost closing on 2,700.
Yeah. What about in Canadian dollars? It's all-time high.
Everyone holds. Well, it's kind of interesting you say that, because here's the dollar going higher. So we're all holding gold, so we're all making money on it. At the same time, what's happening with the US dollar at the exact moment in time?
Still going. It's going higher too. Yeah.
Yeah. US dollar's up 3 to 4%, like over the last 3 weeks here. And so they have the dollar and gold going up at the exact same time, and equities are going up at the same time.
Yeah.
And which market is not doing that awesome over the last few weeks? Rich?
Toronto pre-sales.
China?
The long bond, right? The 10-year bond.
Oh,
right?
China. Also, China gave up loads of that. Remember we talked about China that get that bump from all that stimulus, and it's giving back a lot of that.
So they've come out with another round of stimulus, have they not, Rich?
They're going to keep doing it and doing it. It's a balance sheet recession. They need to write off the debt. They won't. It's just, there's a great podcast, not to pump other people's podcasts, but Richard Koo, who coined the balance sheet recession. He's a Japanese economist from Nomura, and he has a great podcast where he outlines.
It's a podcast?
No, excuse me. He was interviewed on a podcast. He's always constantly interviewed, and he talks about China's balance sheet recession and what needs to happen and what won't happen. And sorry, Keith, carry on. But
yeah, and that's what we're talking. So think about it. If we said to you, gold is screaming to record highs, where is the dollar? Everyone would say, oh, it must be going down. It has to be getting crushed. Nope, it's actually going up at the same time. Oh, wow, if the dollar is getting stronger and gold is getting stronger, well, what's happening to the stock market? It must be crashing. Nope, it's going higher. So again, these are the things that we find really interesting. And you had to be curious all the time when you're looking at markets. And nothing is moving in isolation. And there is, again, there is some, and again, then over this, you have central banks, doing jumbo rate cuts. So there are some really odd things happening. And I don't think anyone really understands yet, though, again, this is not going to be smooth sailing at all. Everything seems fine now because everyone's investment portfolio, everyone's making money. I mean, it's hard not to make money when stock market is going up, the dollar is going up, gold is going up, and well, unless you're
this is really an easing of financial conditions ultimately.
Yes, it is. It is when price earnings ratios fall. But there's one more asset that's been going up too, which we never ever talk about, and we got absolutely eviscerated. Rightly so.
Say it.
Bitcoin is up like Bitcoin. Let's talk about Bitcoin for 10 minutes now.
but that's going higher, but that's
it's up 60% year to date. It's outstripping gold.
Yeah, but it has like 30-40% volatility attached
well,
to it.
now here you go. Cover your run for cover. No, we're gonna get comments.
Yeah, but anyway, but that it is factual with it, and that's not meant to be a compliment or not a compliment. It's just what that market is. But you have oil is bouncing around.
Close again.
It's a bit. Hey, oil is not allowed to go higher until after the U.S. election. I think that's been made pretty clear. And but again, this is going to sort itself out. And I think it does. We start to see what this next phase will look like as soon as the election is over. And as soon as they're finished counting votes, which might be a full year later, who knows how long that's going to take. But again, if you're just reading the markets right now, look at everything. And if you were back in school 10 years ago, 5 years ago, 20 years ago, and you said, yeah, these are the current market conditions, what's happening, you wouldn't understand it. It just wouldn't make sense. That's all we're saying.
So is it safe to say that financial markets are sniffing out the next sort of debasement cycle?
I think they already
Yeah.
have.
I would agree with that.
Race to zero and everything's moving higher. And the economy, while it's slow and struggling, it's really not that bad. And
It's not.
the easing is still going to come. The bazookas are being fired over in China. Even our dear
So if
leaders
we
here in
didn't
Canada.
have, but if we didn't have the Chinese doing their thing and all the central banks being told to do jumbo rate cuts, if that was removed and economic data is suggesting, hey, we're grinding tighter, but we're not in crisis mode. Nothing is collapsing here. Then a lot of the market reaction right now, a lot of it would make sense. You can say, well, yeah, gold is up because of maybe war is happening. Equities are up because it's going to be a soft landing and valuations are okay. The bond market is declining on the long end because inflation is going to come back. You can
But
have
spreads
that.
are tight.
Yeah, spreads are tight because you can never lose money in credit markets. It's for low risk investors, all that stuff. But see, like you keep coming back to, it's the whole rate game. You know what I love about the rate game? Everyone, this is really cool though about today. Usually everyone's an expert with the stock market. Not an expert, but everyone follows the stock market closely. But what's so great now for a lot of Canadians, everyone follows the Bank of Canada closely, like the ferry operator, when they cut rates.
Yeah. My
know.
sister even mentioned it to me to give her 2 plugs in one episode. She's like, "Oh, I think the central bank's going to cut rates this week." I was like, "Oh,
I've
you've
been hearing it from
listening."
everybody. Like even people that don't follow monetary policy probably don't even know who Tiff Macklem is. Right? Remember we were in Calgary? Remember in Calgary and we interviewed everybody in the street?
Yeah,
Nobody
we should do that
nobody knew
again.
who he was, but everybody seems to know that he's cutting rates. And he's going to continue to cut rates. And
Long live the Canadian housing market.
well, Mr. Freeland says no homeowner left behind. And so
Didn't we have another G7 quote
Oh no, please
from the
no.
FinMin? There was
I don't
another
know
one.
if I'm going to read out another one for this episode. I think we've given
Well, it
enough
sort of
of a-
replaced the whole Saskatchewan comment we used to always make. Now we're into the G7 quote world.
Oh boy.
Well,
We're
the
G7.
next
the first
race is-
G7 country to cut rates 3 meetings in a row or something like that. I think it was.
Let's ask
all
our
right.
guest next week about how he feels about the G7. I think that'll be one of our first questions.
Do you want me to read it out?
No, I gotta go.
Inflation fell to 1.6% in September. Inflation has now been at the Bank of Canada's target range for 9 months in a row. The bank has lowered interest rates 3 times, making Canada the first G7 country to do so. This is good news for Canadians and Canadian businesses. And that is a good place to end it. As always, guys, we appreciate the support, and we'll see you next week.